Okay, before we wind up, let us quickly look at some charts. First, I'm going to look at the long-term logarithmic chart of the Sensex. This is the entire Sensex data that we are looking at, and here we can see that it has been channelized all the way from 1978, where the data starts, and the recent 2008 highs were very close to the upper end of the channel, the extreme end, and the subsequent high in 2010 hit a midway channel point, which has acted as a support and resistance level. Now the same chart has the Elliott wave markings for the entire time. I've marked it as wave 1 and 2 in the 80s, the third wave ending in year 2000, the fourth wave, the triangle, and the fifth wave. Of course, my preferred count, if you've been reading Indiacharts, has been 2008, but it can be marked alternatively into 2010. In either case, it's a completed 5-wave pattern within a rising channel all the way from the 70s. A completed 5-wave means that you go back to the fourth wave of lower degree as a long-term target when you complete a 60-70 year cycle. That means the 4,000 to 6,000 Sensex range. That's what the Elliott wave count indicates, though it sounds like a very tough target. Now let's quickly zoom in to what's happened between 2008 to 11. And you can see that prices have started heading down, and the lower end of the channel is what would be an ideal long-term target, which would actually range between around 12,500 to around 11,300. There are two lower channel lines, and that's where the targets stand. As you can see on the chart, I've marked the pattern as A and B. B is a running triangle, and this running triangle forms on the right shoulder of what might be a head and shoulders pattern. So, and running triangles on right shoulders, extremely bearish setups, and often C waves get extended on the way down, and which is why deeper targets get achieved. So this setup appears complete. Wave C started from the high in April this year and would be an extended wave down. There would be halts along the way, but eventually you would see further legs down. So basically the wave C down, which started from the April high, would break up into a 5-wave decline. Moving to the rupee, I've shown in the past 50-100 year chart of the rupee. Now this just takes the data for the last 10 to 15 years, and essentially you ended a multi-year advance somewhere in 2000, which I would say was either a wave 1 or a significant 5-wave advance of several years. The decline from there, when the rupee fell to 38 in 2007, was an ABC zigzag decline, very perfect with a B wave triangle. So it completed a deep correction to what the advance we'd seen the USD INR do for several years. After that, we've seen a clear 5-wave rally in 2008, and then retraced exactly 61.8%. So I'm marking that as wave 1 and 2 of a completely new trend that has started, and have been anticipating a third wave for most of the last 1.5 year to start at some point of time, which seems to have kicked off right now. Now zooming in on the rupee chart, you can see further the breakdown of the counts, a complex WXY correction where wave Y was an ending diagonal, and that's why the pattern ended in a triple bottom at the 44 range, from where we've broken out into a third wave. The target simple equality of wave 1 to 3 would give us something like close to around 58 rupees. You can draw a parallel channel to ascertain that target. And then breaking it down for immediate implications, the breakout of the wedge has been splitting wave into wave, which means you can see the markings here. You're into the third wave of the move, and that itself is split into 1, 2, 3, 4. The third wave itself would have a target of around 51.8 odd, and then by the time the fifth wave of this rally completes, you could be at much above the 52 high seen in 2008. So the way it is splitting, it looks like this rally is going to extend and achieve higher and higher targets rather than break down into consolidation phases, which is somewhat indicative of what would look like a currency crisis, but then when you look at it, it's not just the rupee that is falling against the dollar. Most other currencies from emerging markets are also doing so. This is a chart of the Brazilian real. It's also been going one-sided down. In fact, it's lost more than the rupee has, almost 25% from the bottom. It's not. We are not an isolated case. Similarly, you can look at the Mexican peso. It's also had a one-sided run, and so has the Taiwanese dollar. So what we are really in the midst of is an across-the-board rally in the dollar against various currencies. It's not just the USD INR, and but the implications would be there in terms of the value of the rupee if this trend continues. And right now, the wave counts are indicating a continuation of this trend in the currency market.